Good evening, everyone, and warm welcome to this webinar of Expert Advisory Committee on recent EAC opinion. Myself, CA Parul Gupta, Secretary to the Expert Advisory Committee, and today I'm joined by Chairman Expert Advisory Committee and past President CA Dr. Debashish Mitra ji, and our eminent speakers of the day, CA MP Vijay Kumar ji, CA Vivek Nivatia ji, and CA Dr. Raghavendra Goyal ji, who will be moderating today's session. Now I request our Chairman Expert Advisory Committee to express his opening remarks.
Thank you very much, the Secretary of this committee, Parul Gupta. And those of us who are watching me, and you can see on the side, you'll find that I am, on to my left are four ladies. So you'll see that this is a totally lady-dominated committee. Women empowerment, SDG goals, this committee totally complies with. Right. So 1975 was the year when this committee was formed. MPV has been part of the MP Vijay Kumar ji has been part of this committee for a long time. Vivek Nivatia ji, Goyal ji, they have been part of this committee. And since 1975, this committee has grown from strength to strength. We have given more than 1,600 opinions. Right. So 42, those of us, who ask us how to go about it, how to see your opinions, the compendium of opinions. 42 volumes. Use the search engine. You need not even purchase those books. Use the search engine, go to the site and have a look. Right? And always rely on those opinions. Mind you, last year, I was just telling MP Vijay Kumar that we had about 53 opinions last year we gave. And, we are always looking, that how many opinions come back for review? Are we right in the opinions that we give? Right. And we find that only 1% of the opinions that we give come back for a review. Right. So, we are always looking at 1 to 2%, they come back for review. We are always looking at the quality. Today, those of us who would like to give opinions, would like to refer issues to us, mind you, we complete an opinion in about 2.5 months' time. We try to do it in 2 months' time. In 2.5 months' time, we try to complete an opinion. So we are very quick and fast. And these opinions that we give are of great authoritative value. And, for many of us who are in this committee, Expert Advisory Committee, it's a great learning experience. Over the period of time, I was telling you about 53 opinions we gave last time. And now the opinions, they go on tomorrow. We have a EAC meeting coming up. Most of the opinions that we give today are relating to Ind AS. So the Ind AS, if you are not conversant with Ind AS, is very difficult to give an opinion on this. And let me tell you, some of the best accounting minds in the country, they sit on this committee. And the debates and discussions are furious. Sometimes the people, they hold on to their ground. But and MPV, because MPV has also seen this kind of things. So many people Vivek has seen, Mr. Goyal has seen, so many people, they would like to marry their opinion. And then, as a chairman, I would like to have, see that how we can have unanimity in the whole process. So, this committee is doing fantastic work. In the past, this committee has been organizing webinars. Last year, I believe we had about 9. This is the first time in this year. I don't know how many of you attended this. We had a physical program in Mumbai. And it was well attended. The discussions were very good. So we want to reach out to all of you as we go ahead. This committee, in the past, most of the queries that came to this committee were because CAG wanted the opinions. Because CAG said something to a company, the statutory auditors or the company did not agree and they came back to us. I always said that, if a listed company comes to us without, having the Damocles sword of CAG on its head, then we are doing well. And today what has happened is, a lot of listed companies, they're coming to us directly because we have cut down the time, the time duration for giving opinions. So, the committee is doing well. And, those of us who are attending this, we are going to discuss 6 queries. And let me tell you, people like MP Vijay Kumar are some of the best friends. Vivek Nivatia, MP Vijay Kumar, I have worked with him for 6 years. I know how good he is in accounting standards. In fact, many of these Ind AS, we call him very fondly MPV. You see, MPB has had a hand in developing many of these Indias. He was the chairman of the Accounting Standards Board. So you see, it is our great, pleasure to and a privilege to have him with us in this panel. Vivek Neotia from Calcutta, the place from where I come. He's young, but his knowledge level is very strong. And Raghavendra Goyalji, see, last year he was there, and this year again he's here. You see, he's doing very well. You see, he gives a lot of insights to the committee about what is happening around us, so that the committee can take a decision which is correct and right. So with these words, I welcome all of you to this webinar, and I am sure all of you will find the discussions very enlightening, interesting, enjoyable, and you see, you'll find that the learning that you get at the end of it, I'm sure when you go back home and look back on the 2 hours spent, you'll find that these 2 hours have been well spent. I wish all of you a very, very happy learning. Thank you very much. And Parul, you continue the program.
Yes, thank you, sir. Now, I would request CA Khushbu Bansal, my colleague, to give formal introduction of the speakers for today's session.
Good evening, everyone. We welcome everyone to today's webinar, and we are hopeful that the opinions discussed will be of immense relevance for everyone. Let me take the opportunity to introduce our distinguished speakers for the evening. Our first panelist for the session is CA MP Vijay Kumar. CA MPV sir has extensive experience of more than 30 years. He has served as Central Council member of ICAI for 6 years, from 2016 to 2022. Currently, he is a member of IFRS Interpretation Committee of International Accounting Standards Board, IFRS Advisory Council, and IFRS for Small and Medium Enterprises Implementation Group. He has been Vice Chairman of EAC in past and has also been associated with various committees, boards of ICAI in one capacity or the other, such as ASB, VSB, DAB, FRRB, Committee on Accounting Standards for Local Bodies, etc. Sir has authored 10 publications on accounting, auditing, corporate and allied laws, financial reporting, etc. Welcome, sir. We are honored to have you today with us. Our second panelist for the evening is C. Vivek Nevatia. C. Vivek Nevatia has a professional experience of almost 20 years. He is currently a co-opted member in Expert Advisory Committee and is a member of INDES or IFRS Advisory Group of ASB. He has been associated with EAC for almost 5 years. He has also served as a special invitee of ASB of ICAI. He has been authorized by IBBI as a registered valuer for securities or financial assets. Welcome, sir. It's a privilege to have you as a speaker today. Today's session will be moderated by C. Raghavendra Goyalji. C. Raghavendra Goyal represents one of the leading chartered accounting firms from Delhi NCR. He has a vast experience of central statutory audits of banks and listed entities, forensic audits, and consultancies on various accounting principles. At present, C. Raghavendra Goyal is a special invitee in Expert Advisory Committee of the ICAI. Welcome, sir. We are grateful to you for joining the session today. Thank you, everyone, for joining in. And over to you, Raghavendra, sir, for starting the session. Thank you.
Thank you, Khushbu ma'am. Good evening, everyone. Our very dynamic past president, CA Dr. Debashish Mitra, sir. Panelists for today's session, MP Vijay Kumar ji and Vivek Nevatia ji, and all the dear attendees. So today, as in the inaugural address, Mitra sir has said we would be discussing about 6 queries. And see, the entire purpose of the webinar is to disseminate the information to the members at large, be it in the practice or be it in the industry, so that we as a whole, as a community, can come up with a good financial statements. So the first opinion that we are going to take today would be on recognition of windmill plant as a property, plant and equipment, or as a right to use asset. So this issue came up once the Ind AS 116 came into being. So after that, this issue started. So first I would read what was the facts and then what was the query asked. And then I would request MP sir to dwell upon what is the solution which the EAC gave to the queries. So the facts goes like this. The company is engaged in the business of consultancy business of energy management. Yeah, the slide is changed now. Thank you. Including renewable energy. The company owns a 26 megawatt wind power plant The plant consists of 13 wind terminal generating of 2 megawatt each. Entire energy of the plant is transmitted to a specified traction substation of Indian Railways in terms of a 25-year power purchase agreement with the nodal railways. The 26 megawatt plant is part of a large 572 megawatt wind farm developed by the developer. Land from the wind farm was allocated to the developer under the state land lease policy. Developers subleased the land to the respective CPSCs, including the company, based on the area covered by their wind plants. The company recognized the entire cost, including one-time land lease charges, as property, plant, and equipment. Depreciation was provided on a straight line method based on a technical assessment of the useful life, which was assessed at that point of time at 25 years. After the introduction of Ind AS 116 leases, the company segregated the cost of leased asset and has shown it as a right of use asset. Revenue from sale of power through windmill project is recognized on the basis of certificate from concerned state electricity authority for energy fed in kWh in authority system and as per terms and condition of the contract with the beneficiary. As per the company's technical estimate, windmill plants have a higher useful life of 25 years. Now, the auditor's views. Can you change the slide, please? The company set up a 26 megawatt wind energy plant in the state for the exclusive supply of power to Indian Railways. In this regard, a power purchase agreement was also entered into by the company with the Railways for a period of 25 years from the date of commencement of supply of power or till the life of the wind farm, whichever is later. The company has disclosed this wind power plant as property, plant, and equipment instead of finance lease in violation of paragraph 9 of Ind AS 116 leases. Therefore, this has resulted in overstatement of property, plant, and equipment and understatement of financial lease. So basically, the auditor wanted this to be classified under Ind AS 116, otherwise under property, plant, and equipment. Now, what was management's contention? Management said that PPA is only defining the right to obtain the energy with an obligation to use it for a specified purpose, and no other right has been defined under the PPA. PPA does not give any right, explicit or implicit, to direct the use of wind plant to railway. On the contrary, it can be concluded that right to direct how and for what purpose the wind plant is used throughout the period of use of plant is not relevant in view of the nature of asset. Wind plant can only be used in the manner as decided by the operator, the company, and the purpose is already defined in the PPA. As such, how and for what purpose a power plant used is predetermined in case of a power plant. As per para B27 of Ind AS 116, when how and for what purpose is used is determined, decision-making rights relating to operating and maintenance of the assets are relevant. Thus, when how and for what purpose is predetermined, an operating decision is taken by supplier, it is not a case of a lease. So this is what the management contended, why they have not classified under Ind AS 116. Since decision-making rights regarding operation and maintenance are with the company and not with railways, and how for what purpose is used is predetermined, condition of paragraph B24 small b1 of Ind AS 116 is not satisfied. Further, the windmill plant was constructed by a developer who was engaged by the company for setting up of windmill farm for lump sum turnkey basis with comprehensive operation and maintenance services. The wind farm has been designed, constructed by developer for supply of energy to different type of customers, including public and private. As such, there is no role of the railways in designing the 26 megawatt wind energy plant. Accordingly, the condition specified in paragraph B24 small b2 is also not satisfied. Accordingly, the railway does not have any right to directly use the wind energy plant. As such, the management is of the considered view that the fact of consumption of entire output generated from the windmill plant by Indian Railway does not conclusively indicate the availability of right to direct the use with Indian Railways. Management also stated that paragraph B29 of Ind AS 116 clarifies that ability to specify the output in the contract before the period of use without any other decision-making rights available to the use of the asset gives the customer the same rights as any customer that purchases goods and service. And therefore, they have not considered this under Ind AS 116. Now, the query that was put before the board reads as under whether recognition of windmill plant as property, plant and equipment as per Ind AS 16 is appropriate, or the same should be considered as a finance lease of the asset as was suggested by the statutory auditor. If not, how to recognize the above assets. So now I would request MP sir to kindly dwell upon the above topic and how was the correct treatment given by the EAC.
Thank you, Dr. Raghavendra, for that wonderful introduction of the issue in hand and the contention of both the parties. At the outset, my sincere thanks to the chairman of the committee and Honorable Past President, Dr. Debashish Mitra, and colleagues from EAC, Parul and her team, for the invite. Extremely happy to be here today. And I just got a small feedback that there are almost about 300 people who are attending the webinar. Thank you all for the time for joining this webinar. Your participation and the interaction in this particular webinar gives us more insights in terms of the way the users look at application of standards. And it also adds to the capacity of the EAC staff in terms of how the users get to apply the standards or look at the standards. So coming specifically to the query, since the query has been introduced in fair amount of detail, let me begin with first a small caveat that this particular opinion has been evaluated by the committee solely looking at the facts of the case and not looking at how the legal agreement is structured between the parties. The facts have been evaluated only from an accounting perspective. And it is also assumed that the company in this case is acting in the capacity of a principal and not as an agent of the railways. That's an important caveat because it could change the way the treatment would otherwise be done. In this case, about 26 megawatt of capacity, 2 megawatts of each windmill, 13 windmills have been installed, and the entire energy is to be transmitted to a specific substation of Indian Railways in terms of the power purchase agreement which has been signed up. The query beforehand for us is whether the agreement to sell energy to the railways, the assets should be treated as a finance lease or a regular commodity sale, a normal transaction of sale of energy. Important to take note of a few facts which the company has submitted to the EAC. One is the company has an obligation to supply the entire wind energy generated from 26 megawatt wind farm to the railways. So whatever is generated, all of the generation is to be supplied only to the Northwestern Railways. Second of the points which I'd like to highlight is that the Northwestern Railway has entered into this agreement for consuming the whole of the energy for their captive use. And the third important agreement component is that this particular agreement between the two parties shall continue to be in force for a period of 25 years from the time of commencement of supply of power or till the life of the wind farm, whichever is later. So which implies that the entire asset will be sweated out solely for the benefit of the railways. That is the end user of the energy. Now, these are some of the key clauses in the agreements which I thought I should bring it to your attention for understanding how this has to be evaluated. since the discussion has started around whether it is to be treated as a lease, let's look at some of the provisions of Ind AS 116. To begin with, let's try to understand the definition of a lease so that it will help us to evaluate as to whether this particular arrangement fits into the definition of a lease. So in 116, lease is defined as a contract or a part of contract that conveys the right to use an asset, whatever is the identified underlying asset, for a period of time in exchange for consideration. The standard also requires that right at inception of the lease, the entity has to assess whether the contract contains a lease. And a contract would assume to contain a lease if, as I highlighted, there is a right to use an asset which has been transferred. Or in other words, if the contract conveys the right to control the use of an identified asset. In fact, in Ind AS, including in the revenue standards, even in the asset standards, what is critical is the control. So even when we use the expression right to use, it effectively means right to control the asset. Is that right to control the asset transferred? And for this particular assessment, we have some paragraphs of literature available in the standard. I will not harass you by quoting the paragraph numbers, but I'll try to bring in verbatim those sentences in the standard so that we have a better appreciation. The right to control, that is the use of an asset, is tested when both of the following conditions are there. Both of the following conditions are there. One, the right to obtain substantially all the economic benefits from use of the identified asset. So that's the first condition. So as a user, from that 26 megawatt of windmill, I should be able to get the full benefit. Second is the right to direct the use of the identified asset. So I should be able to tell how this asset is to be used. So both conditions need to be fulfilled. It's not either or, it is both of the conditions which needs to be fulfilled. Now, as far as the right to direct the use is concerned, that is where the entire evaluation happens. I told you two conditions. One is right to obtain all of the benefits. In this case, the windmill is exclusively for the railways. So all of the benefits are coming to the railways. The question is on the second condition, that's the substantive part of the evaluation, that is the right to direct the use. So let's understand what the standard has given as guidance in terms of evaluating the right to direct the use. The standard provides that a customer has a right to direct the use of an identified asset throughout the period of use if only if either A, the customer has right to direct how and for what purpose the asset is used throughout the period, or the relevant decisions about how or for what purpose the asset is used are predetermined, and there are two subconditions for this. Italic 1, the customer has right to operate the asset throughout the period of use without the supplier having the right to change those operating instructions, or the customer designed the asset in a way that predetermines how and for what purpose the asset will be used throughout the period of use. So just to do a small recap here, because this is a critical part of the evaluation. So first is, you will have a lease arrangement if two conditions are fulfilled. Benefits in full. Second is direct the use of the asset. Now, part 2. For directing use of asset, either A or B. A is the customer, he should be able to decide how and for what purpose. It's the customer's choice. Or where it is predetermined, like in this present case. In the present case, it is predetermined. It is predetermined that it is windmill, these specific assets, this size capacity, this is where it will be installed. Everything is predetermined. So where it is predetermined, you need to evaluate, does the customer have the right to operate the asset throughout the period of asset of their lease arrangement, or where the customer has designed the asset and he has decided for what purpose it will be used. So these are the two questions we have to now evaluate. So narrowing down on these two questions, the entire focus now comes to the predetermined arrangement. Wherever there is a predetermined arrangement, how is this evaluation got to be done? For this, the entire focus comes and concludes in a very specific paragraph. In fact, the solution to the whole issue comes into one specific paragraph, which is paragraph B24, which provides that if the relevant decisions about how and for what purpose the asset is used is predetermined. In this facts of the case, it is predetermined. A customer has right to use an identified asset throughout the period if the customer has a right to operate the asset, as I mentioned a little while ago, or he has designed the asset. So these two conditions are what needs to be evaluated. And if you look at the specific facts of the case here, the customer's involvement is limited. It stops. It's limited to giving broad guidelines to the supplier. You basically tell, I want 13 windmills, 2 megawatts, generating so much, hand over. So he gives a broad framework. That's what his role stops. But as to how those day-to-day operations to be carried on, etc., are all the decisions of the supplier. It is the supplier who decides as to how that engineering should be done, how the blade's direction should be kept, what speed it should function. All of those aspects are the sole decision of the supplier in this case. So given this backdrop, even though everything is predetermined, the customer does not have the right to decide on how the asset will be operated on a day-to-day basis. So given these facts, it is concluded, part A, that it is not a lease arrangement. And as a corollary, it is a simple supply of electricity. So between the company and the railways, it's a simple contract of a supply of electricity. And that's how the whole accounting needs to be done. So this is the analysis of the committee and my own understanding of how the standard needs to be applied for the facts of the case. So happy to interact further on this. And over to you, Parul and Kushbu. And Dr. Raghavendra, over to you.
Vivekji, any inputs you want to pitch in this one?
I think Mr. MPV sir has brought out the points very finely. Sir, just one or two clarifications which I may just put forth for your inputs. This question on whether the right to direct the use, how do we actually decide whether the customer has designed the asset? To what extent will the involvement of the customer be considered as material, or would it not be significant? To what extent, as an auditor or as an accountant, do we decide as to the involvement of the customer with respect to the designing of the relevant asset concerned? For example, in this case, it's a windmill which would be a standard technology product, but it could be a more complicated power plant, so as to say, or it could be a solar plant which is designed which would be designed basis the direction of the relevant customer. To what extent should the materiality of the involvement be decided, the direction of the customer concerned?
Okay. So Vivek, my understanding is the following. There are, in para B24, B, there is this ITLIC 1, ITLIC 2. ITLIC 1 basically talks about, does the customer have the right to operate the asset throughout the period and things like that? In this case, the answer is no. and consequently it tilts towards becoming tilts towards not being a lease arrangement. So that's ICLIC 1. Now I evaluate ICLIC 2. So in the fact, and this ICLIC 2 is about how much is the customer's involvement in designing the asset, which basically is predetermining what that asset is concerned. I think it is facts based. It is generally based on facts. Typically, if you take a windmill kind of an arrangement, the customer's involvement, typically a customer who sources electricity, his involvement is basically to say that I want windmill typically of this capacity. In fact, it does not even go to the extent of saying that whether it should be a 2-blade windmill or a 3-blade windmill. You don't even actually go to that extent, but some customer might, depending on subject knowledge, might get involved to that extent because they want to get the maximum plant load factor also, the maximum PLF they would like to get it. So as far as the customer's involvement is concerned, it's very fact-based. But in a typical windmill, where you have a windmill operator and you have a customer like Northwestern Railway, it is more likely that the customer involvement in designing is likely to be limited. Customer involvement in designing normally will happen like, let's say, for example, I'm in shipbuilding, I'm in aircraft construction. So I would design, tell somebody, go and install it or prepare it in this way and make it available to me. So that design IP would be with them. But in a windmill kind of a fact pattern, as we see here, it is highly unlikely that the customer has a substantial degree of involvement with reference to designing the asset. And that has to be determined only on basis of facts.
Okay, sir. Thank you, sir.
Thank you.
Okay, so moving on, again, the next query that we are going to take is on Ind AS 116 only. This is regarding classification of portion in the common office complex occupied by parent company as investment property in the subsidiary company's financial statement under Ind AS framework. So the facts goes like this. This is a public limited company, which from now on we would be calling it as a child limited or the company. It's a wholly owned subsidiary of parent limited. Child limited as well as parent limited acquire adjacent pieces of land from State Development Authority on a perpetual lease, which was capitalized as PPE asset at the time of transition to Ind AS and subsequently has right to use assets upon transition to Ind AS 116. The land parcels were acquired by group companies for construction of their respective office complexes. Subsequently, at the time of construction of office complex over the said plot of land, both the companies requested the SDA, the State Development Authority, for amalgamation of their adjacent plots. SDA provided its approval for amalgamation of both the plots. A multi-story office complex was constructed on the amalgamated plots comprising 2 towers of 5 floors each with common basements and ground floors. The total construction cost of the building was X crore, out of which 50%, 50.125% was incurred by and capitalized in the books of Child Limited, and the remaining 49.875% was incurred by and capitalized in the books of Parent Limited, thereby giving the right to both the companies to utilize the properties in the aforesaid ratio. However, the actual utilization of the building is in different proportion from the ratio in which the cost of construction of the common building is capitalized in the books of respective company. Out of the 5 poles in Tower B pertaining to Child Limited, 2 floors are occupied by the parent company for their official use since first occupation, and remaining 3 floors are used by Child Limited for its official use. So if I go to a pictorial representation, in the Tower A, the entire 5 floors are used by the parent company. In the Tower B, which is owned by Child Limited, first 2 towers are owned by the parent company and the rest 3 towers are owned by used by the Child Limited. The basement and the common floor remains common. So though expenditure in total is 50% approximately, but the usage is not actually 50%. Majority usage is towards the parent company, and 3 floors out of 4 is with the child limited. So since the portion of the complex occupied and used by parent limited is in excess of its proportionate share, therein it is akin to a beneficial interest enjoyed by parent limited. Therefore, auditors were of a view that the arrangement being a related party transaction should be at arm's length, and accordingly, child limited should charge consideration from parent limited for such beneficial interest. In view of the audit observation, parent limited and child limited agreed on the following approach. Purchase of the said 2 floors by parent limited from child limited after conversion of the leasehold land into freehold and partition of the property, and pending the process of conversion of property into freehold, entering into an arrangement for identifying beneficial interest for the portion of office occupied and used by parent limited. In view of the above, parent limited and child limited applied to the SDA for conversion of the leasehold land into freehold, because in the then understanding of child limited, without the property being converted into freehold, the purchase of the said 2 floors or charging of consideration of use from parent limited cannot take place. During FY 2022-23, child limited and parent limited revisited the position, and in discussion with legal experts, arrived at the conclusion that even though in the absence of conversion of property into freehold and without partition of the common property, child limited cannot sell or lease any portion of the building to parent limited, it can still enter into an arrangement for charging a consideration from parent limited for the excess portion of office complex occupied by it. And thereby they would be solving the question of arm's length price. Accordingly, child limited entered into a memorandum of understanding with parent limited. Thereby, both the parties agreed that parent limited shall continue to enjoy the beneficial interest, and in lieu of that beneficial interest, they would be giving a consideration to parent child limited. The terms of MOU began retrospectively with effect from 1st August 2017 and will be further valid for a period of 10 years. Auditors observed that since child limited is deriving rental income from the 2 properties being occupied and used by parent limited, child limited should classify the 2 floors as investment property, and only the remaining portion of building used by child limited for its own use should be classified under PPE. So now out of the 5, since 2 floors are used as an investment property, those 2 floors should be classified as an investment property, and the remaining should be classified under property, plant and equipment, or under right to use asset. Child limited stated that the arrangement of charging consideration is incidental and ancillary to the beneficial use, and is done as per the convenience of the group companies to ensure that the transaction, being a related party transaction, is at arm's length price. As such, the primary objective of the company is not to earn rentals or capital appreciation from the said 2 floors. Auditors, on the other hand, also observed that as jointly agreed by both the companies in the joint executive meeting, an in principle approval has been given for selling of 2 floors by child limited to parent limited after conversion of property to freehold and execution of partition deed. Since the land has been acquired in 2003 and building has been constructed later on, so capital appreciation on the same cannot be ruled. Though child limited would be selling these 2 floors to parent limited, which is parent company, since both are separate parties acting independently in their self-interest and not taking capital appreciation by child limited from the parent limited does not sound prudent business practices. So these were the facts of the case. Now the query that was put before us was, child limited is required to classify the said 2 floors as investment property in its financial statements, or the current classification of the said 2 floors under property, plant and equipment, which is done by child limited at present, is appropriate. So now I would request Vivek ji to kindly dwell upon this query.
Thank you, Mr. Goel, for clarifying the facts of the case very, very nicely and bringing out the fact pattern in a very lucid manner. Coming to the facts of the case which has been brought out by Mr. Goel, I think one point which is very evident from the facts of the case is this was a transaction which was structured to ensure compliance with the arm's length principle. I think both parent and subsidiary were co-owners of the land, were building the property, both the towers for their respective use. Tower 1 was being constructed for the purpose of the use of the parent. Tower 2 was being constructed for the purpose of the child. And the objective of the construction of the respective buildings, the cost that was being incurred in the ratio of 50%, was to use it for their own purposes. Now, based on the observations of the auditors, it was identified that since parent company was in possession of two of the floors out of the five floors which the construction was completed by the child, there was a requirement to appropriately compensate the child company for the usage of the space by the parent. So in the facts of the case, we are using the term beneficial interest of the parent in respect of the two floors which were utilized by the parent for its own business purposes. And the beneficial interest was on the property which was constructed by the child company, the company which we are dealing with here. So coming to certain disclaimers, which is very relevant when we read an opinion of an expert advisory committee. These disclaimers are something which we should read before we start reading the opinion. I think these disclaimers help us to identify which aspect of the accounting standard is something which expert advisory committee has not looked at, considering the queries which have been raised by the questions. So we first should be very well aware that this disclaimer is something which is very relevant for us to understand, because this helps us to understand and analyze where the opinion can actually be applied for our facts if there are similar facts in our case. So firstly, they have not looked at, the committee has not looked at whether the transaction of compensation in the form of rent or sale, or what is the arm's length, actual arm's length. They have not gone into the subjectivity of what the arm's length is. They have assumed that this transaction which the company is doing is at arm's length. Second is they are not looked into the accounting of the retrospective MOU which is proposed to be, which has been entered into in the current year, the compensation of the rent which is being proposed to be made from the year 2017 till the current year by the parent company to the child company. So we have not looked into how the accounting of that retrospective rent which is being paid by the parent to the child is to be done for the purpose of the child limit. So we have not looked into those aspects. We have basically looked into the classification issue, whether this particular asset, which is owned by the child limited, the land and the relevant building which is constructed, the two floors specifically, the beneficial interest of which presently is being enjoyed by parent limited, whether those two floors would be accounted for as investment property or would it be accounted for as property, plant and equipment. So that is the broad principle that we are looking at when we are looking at this particular fact. And based on this, we'll proceed with the analysis of the case. So generally speaking, when you look at a particular transaction, we look at a property wherein we are earning a rent, and possibly that there is an agreement to enter into a sale agreement with parent limited for the two floors which are there. So there's a tendency to look at this transaction as, look, this is an investment property. So we need to understand one fact pattern very clearly here, that this property which is constructed by child limited, the two floors, the objective of sale was to ensure, or the objective to enter into the MOU was to ensure that the arm's length principle is justified and the two floors, if they are sold to the particular parent limited, this is being done to ensure the related party transactions are being met with. However, where the child limited has taken a legal opinion and now it says that possibly the sale may not be required to be undertaken, because based on the present legal opinion which child limited has taken, that if child limited is adequately compensated in the form of rent for the two floors, there may not be a requirement to convert the present leasehold property into freehold and also to sell the two floors to parent limited, because that requirement will not arise if the compensation is already happening at arm's length. So what the committee had done is basically to analyze the position as of today, considering the present position as a leasehold property without it being converted into a freehold property, and look at how this two floors, the rent which is being receivable from parent limited would be accounted for, and how whether this would be treated as an investment property, the portion, the two floors which has been let out to parent limited. So now let us look at the definition of investment property, which has been put in Ind AS 40. What is investment property? A property, land or a building or a part of a building held by the owner or by the lessee as an ROU asset. So even a lessee holding it as an ROU asset can hold a particular property as investment property. This is something which is an important principle to be remembered. To earn rentals or for capital appreciation or both. So if I have an objective to earn from that investment property, from that land or building or part or both, to earn rental or hold it for capital appreciation and not hold it for use in the production or supply of goods or services or for administrative purposes or for sale in the ordinary course of business, or I'm not holding it as inventory, or I'm not using it for administrative purposes, in which case this property becomes an investment property. So a property, if it is held for the purpose of earning rentals or for the purpose of capital appreciation, would be classified as an investment property. If it is not held for production or supply of goods or rendering of services or for administrative purposes or as inventories. So these are the broad principles basis which investment property is defined. Now, there are certain examples which are put in the Ind AS with respect to what are examples of investment property, and there are certain examples which are not considered as investment. So, what is not considered as investment property is one example which has been given is owner-occupied property held for future use as owner-occupied property, property held for future development and subsequent use as owner-occupied property, property occupied by employees, and owner-occupied property awaiting disposal. So even those properties have been excluded from the category of investment. So as an example. So again, when we look at the standard, we read the complete standard. The standard also clearly says that some properties comprise a portion that is held for rental and some portion and another portion that is used for administrative purposes. So there could be a scenario where a particular property is held for the purpose, part of it is held for rental and part of it is held for the purpose of administrative purposes. I could have probably a land wherein I have a contiguous portion of the land where I'm using most of it for my administrative purposes. A portion of it could probably be lent out for warehousing or storage or or leased out for particular storage purposes to another entity. Now, if the portions, what it specifies in para 10 of Ind AS 40, if those portions cannot be sold property, cannot be sold separately, if the portions which are used, one portion which is being used for administrative purposes and the other portion which is being leased out probably, if those portions cannot be sold separately, the property is an investment property only if the portions, the entire portion would be investment property only if an insignificant portion is held for use in or administrative purposes. So what it says is if I have a contiguous portion of the land and if the entire portion cannot be sold separately, the property shall be an investment property only if the insignificant portion of that entire contiguous property is held for administrative purposes. So if a significant portion is held for administrative purposes, the entire portion cannot be considered as investment property. Is what para 10 says. So this is a very important para when you look at the present facts of the case. So that is why I am highlighting this particular para in more detail. Also, the Ind AS 40 says, para 14 says that we need to exercise judgment whether a property is classified as an investment property. And when you are classifying a particular property as investment property, this judgment should be demonstrated. This judgment should be demonstrated on record. And what it requires is this judgment has to be applied consistently in accordance with the definition of investment property which has been given and guidance which has been given in terms of how the application of the particular paras required. And we have to disclose, as para 75C, the disclosure principles of Ind AS 40 requires us to disclose this criteria when the classification is difficult. So there could be scenarios where you are not able to decide on a particular classification, whether a particular item would be classified as investment property or property, plant and equipment. So in which case you may require to exercise judgment considering the guidance which has been given in para 7 to 13 of India's. So wherever this judgment is exercised, we are required to disclose this criteria, the judgment, the principles on which this judgment has been exercised to determine whether a particular item should be held as investment property or property, plant and equipment. So when we look at the present facts, now when we look at applying these principles in the present facts, now we look at this entire property owned by Child Limited. This, according to the facts or according to what has been presented by Child Limited before the committee, that this entire building has been built at its cost and it's held as on a perpetual lease. It is not practicable for Child Limited to sell individual floors of the respective building without conversion of the leasehold property into a freehold property and obtaining partition deeds for each of the floors. So, as per the fact pattern, they have said that it will not be possible for them to bifurcate and sell individual floors of the property which is held, of the property or the construction of which has been done by Child Limited. So based on this principle, based on the principle which, or based on this facts and the principle of para 10 which we just discussed, wherein the property, if held jointly, when the property is a contiguous property and portion of the property is being used for administrative purpose. So for example, in this case here, the 3 floors are being used by Child Limited for its own administrative purposes. And the 3 floors out of 5 floors cannot be considered as an insignificant portion under any stretch of imagination. So since these 3 floors are basically are being used by Child Limited for its own administrative purposes, and the fact pattern that Child Limited is saying that the entire building cannot be demarcated into separate floors for the purposes of selling it separately, because firstly it is required to convert the leasehold into freehold and obtain partition deeds for each of the floors for it to be sold. So basically what it says is, since it is not practicable for each portion of the floor or each floor to be sold out separately, the para 10, based on application of para 10, the entire property, the entire construction cost which it is incurred along with the land which has been acquired by Child Limited will be required to be disclosed as part of property, plant and equipment. The only point that a committee went on to say, since there was significant judgment which was required to be exercised in this case, the judgment basis which the property was classified as property, plant equipment should have been disclosed as part of your notes and accounts. So this judgment is required to be disclosed based on the parameters based on which this has been classified as property, plant and not as investment. Would have made clear the basis which Child Limited has decided on whether this building should be classified as investment property or property, plant and equipment. Since the Child Limited has classified this as property, plant and equipment, I think a disclosure on the judgment basis which this has been done would have made the financial statements more transparent and clear to the readers. And probably the questions would not have been asked by the auditors concerned if no judgment would have been there. So I think this entire case or the entire fact pattern and this opinion brings out when and how to classify a particular property, land or building as an investment property is something which is very nicely brought out in this video. I think this is all that I wanted to say in this. MPV sir, Dr. Goyal.
No, excellent. I think there's nothing more to add on this.
Thank you so much, Vivek ji, for excellent insights on through this one. Now, from Ind AS 116, let us go to one more favorite topic which comes to EAC. That is on Ind AS 115, and probably I think this is one of the Ind ASs which would have most number of queries. And probably this was the reason that this came in only at the last juncture, not at the time when Ind AS was coming. So this is on revenue recognition from customer contracts with customers under Ind AS 115. And again, the industry also is very complicated. This is regarding a shipbuilding industry. So I would go through the facts of the case. The company is one of the leading shipyards in India. The company is engaged in construction of various categories of vessels, ships like defense ships, tankers, bulk carriers, passenger vessels, etc. The ship vessels are constructed against specific orders from the ship owners and are custom made to suit the requirements of the ship owners. Then the shipbuilding process has been explained by the company, which comprises of hull construction, outfitting, sea trials, cost structure, period of construction and consideration. So in the cost structure, what the company has said that the components of the total cost in shipbuilding are material cost, subcontract cost, direct expenses, direct labor, and the overhead. Since this is made to specification, designed and constructed to specific requirements of customers, proportion of the cost components varies across the project. The cost of conversion per ton of the vessel varies from project to project depending upon the intricacies of the work involved. The period of construction of the project range between 2 to 8 years. The consideration for the shipbuilding contracts are received based on the milestone achieved over the progress of the vessel. So basically, since it is a long-term contract, so depending upon the milestone that the company has entered with the respective customer, the billing is done. Now, what does the accounting policy of the company says? Revenue from contracts with customers is measured based on transaction price, which is the fair value of consideration received or receivable. Revenue is recognized when company satisfies performance obligation by transferring promised goods and services to customer over a period of time using output method based on measurement of physical progress completed to date in respect of contracts with customers for shipbuilding. Recognition for revenue for a performance obligation satisfied over time is made only if company can reasonably measure its performance towards complete satisfaction of performance obligation. The company exercises significant judgment in measuring progress of performance obligation satisfied over time for recognition of revenue from contracts with customer by involving the technical expertise to determine the percentage of physical progress of completion for each and every ship based on the technical estimate, considering the latest available information to the company. The progress measured towards complete satisfaction of a performance obligation in the method adopted is revised, updated on an ongoing basis. During the initial stages of the contract, where the company may not be able to reasonably measure the outcome of the performance obligation, and the company expects to recover the cost incurred in satisfying the performance obligation, revenue is recognized only to the extent of cost incurred until such time that it can reasonably measure the outcome of the performance obligation. Now, as per para 32 of Ind AS 115, the company determines that at the inception of each shipbuilding contract, whether it supplies the performance obligation in time in accordance with paras 35 to 37. As per company's assessment, company's performance does not create an asset with an alternative use to the company, and the company has an enforceable right to payment for performance completed to date. Hence, the criterion specified under para 35C of Ind AS 115 is met, and consequently, the company transfer control of vessel built and recognizes revenue over time in line with para 35 of Ind AS 115. During transition to Ind AS 115, the company adopted the output method for measuring the progress of the performance obligation for revenue recognition, and the physical progress is measured at percentage of actual achieved constructed tonnage of the vessel on the estimated total tonnage of each vessel. The company adopted this methodology since this method provided a faithful depiction of the company's performance to the satisfaction of the performance obligation. Current status: as part of its expansion program, the company is diversifying its portfolio across different segments. Considering the technical specification of vessels to be constructed in current and forthcoming years, each vessel is unique for many reasons. The purpose, technical specification, and characteristics of each type of vessel is different. Design specification, drawings, and class certification norms are also different. Also, many of the defense vessels that have been recently contracted are weapon intensive, and the material cost forms a major part of the total vessel cost. Difference in the nature and complexity of ships likely to be constructed in future out of current orders in hand may result in financial hardship. Therefore, adoption of the same methods of income recognition for all the projects under construction may not faithfully depict the progress of the performance obligation for the purpose of revenue recognition. The company further stated that each contract is a distinct contract for design, construction, and delivery of ship, is customized to the requirement of buyer, is different from the other, and does not have an alternative marketing agent. Hence, the company proposes to realign its accounting policy and method of measuring progress in recognizing the revenue for shipbuilding segment. The company plans to assess the performance application at the inception of each contract with regard to applicability of input or output method vis-a-vis similar circumstances or similar performance obligation. At the time of assessment, the company shall assess whether input method or output method would faithfully depict the entity's performance towards complete satisfaction of the performance obligation with respect to specific contracts. Now, the queries that were sought from the board: one, whether different methods of measurement, output and or input can be applied to different vessels within the shipbuilding segment based on the assessment of the company having regard to the specific characteristics of the performance obligation. Whether the change in the method of measuring progress from output method to input method for revenue recognition is to be considered as change in accounting policy or a change in accounting estimate. See, now this becomes very important because change in accounting policy, there would be a retrospective application, and with a change in accounting estimate, we can do a prospective application. The third thing that the company asked is regarding in case of adoption of an output method for revenue recognition, whether the company can account for work in progress when physical progress of completion is less than the financial progress of completion. So these were the three queries that has been asked. So now I would request MP sir to kindly dwell upon the above topic.
Yeah, thank you, Dr. Ravindra. The beauty of EAC is if you spend 2 years or 3 years there, you get to learn about so many industries, and each of them have so many different attributes. Before I come to this opinion, this particular opinion evaluation, I just want to bring attention to all the members, and I would like you to encourage and also disseminate to the peer community of professionals. As far as application of Ind AS is concerned, we have the standard per se, but we also have what we call as the basis for conclusions, which is a very important part of the literature of applying the standard. So in India, what we typically have access to is the standard per se, as Ind AS notified under the Companies Act. But as all of us are aware, Ind AS are nothing but IFRS for all practical purposes. Leave aside those small carve-outs, largely transition in nature. And consequently, every paragraph of every standard, the basis of how that particular paragraph has evolved or the conclusion of that paragraph has evolved is available in this literature called Basis for Conclusion, which is accessible for all of us. Param, is it available in the institute website now? ASB page, it's available, or we are just only subscribed? Okay, let her respond, I think. Paral? Your screen is frozen. Okay, you can respond later maybe. Okay, but it's accessible. I recall it used to be available in the Institute ASB page. It used to be available. I'm not too sure if it's available now because I have a direct subscription, so I get access to that. But it's a very important part of the literature we should always refer to. And in this opinion, the EAC has quoted substantially from the basis for conclusion. And it's important, all of us here, and I make a very sincere and humble prayer to all that you please disseminate to all professional colleagues. Even when the regulator like NFRA tomorrow evaluates the way we applied an accounting principle, they will certainly look at what is the guidance which was available in the basis for conclusion, and only basis that they will evaluate compliance or otherwise. Now, coming specifically to this particular issue on hand, evaluation of Ind AS 115, we have 3 queries as Dr. Raghavendra had put it up. I'll go one by one. So first of the query is regarding input method or output method. What would be appropriate? I'll quickly draw reference to certain specific parts of the standard, and similar to the previous one, I assure you I'll not quote the paragraph numbers, but I'll just read out the sentences verbatim to extent possible. 115 requires that an entity shall recognize revenue when or as, when there is completion, or as the entity satisfies a performance obligation by transferring a promised good or service to the customer. And an asset is transferred when, that is on completion, or as the customer obtains control of that particular asset. And in this particular case, facts of the case, we are looking at over a period of time recognition. So in those cases, for each performance obligation which is satisfied over time, an entity shall recognize revenue by measuring the progress towards complete satisfaction of that performance obligation. And the objective when measuring progress is to depict an entity's performance in transferring the control of goods or services which are promised to a customer. And it goes further to state that an entity shall apply a single method of measuring the progress for each performance obligation which is satisfied over time, and shall apply that single method consistently to similar obligations and in similar circumstances. And obviously at end of each reporting period, you should remeasure the progress towards the satisfactory completion of that particular performance obligation. Now, what are the methods for measuring the progress? Appropriate methods of measuring include, it's an inclusive definition, include input method, output methods. They include, there can be other methods as well. Input methods, output methods are specifically named, but there can be others as well. In determining what should be the appropriate method for measuring progress, input method, output method, or maybe anything else, an entity shall consider the nature of the good or service that the entity has promised to deliver. And the standard goes on to recognize, and this is explained through the basis for conclusion. And that's why the basis for conclusions become important. In the basis for conclusions, with the debate on how they arrived at this particular principle. They provide that there are various methods that an entity might use to measure the progress towards the complete satisfaction of a performance obligation. And considering the breadth of the scope of IFRS 15, it covers every kind of revenue. The board, the single method, input method, an output method, whatever is appropriate for that particular nature of goods or services. And they go on further to say that this does not mean it is a free choice. This does not mean it's a free choice. And let me say that not just in the context of Ind AS 115, even in the context of our inventory choice of method, let's say first in, first out, weighted average, it's not a free choice. Or even depreciation, the way you estimate, it's not a free choice. So while there are methods, you are required to apply what will eventually achieve the objective of a fair presentation. Now, the requirements go on to state that an entity should select a method of measuring the progress that is consistent with a clearly stated objective of depicting the entity's performance in satisfying the transfer of goods or services to the customer. And the board also went on to say that you should not use different methods to measure performance in satisfying the same or similar performance obligations. Like, for example, in shipbuilding, we had so many activities. So in a particular contract, there's a shipbuilding, there's a particular activity. Another shipbuilding contract, there's an identical activity. You can't use input here and output there. You have to use it consistently across. So it's not just like for one shipbuilding contract, I will use the input, another I'll use output, or that particular obligation I'm using input here, whereas there I'll use output. No. As long as the fact pattern is similar, you are required to consistently apply both for that contract and for similar contracts as well. And at end of each contract, you are required to recognize what is an appropriate performance, appropriate remeasurement, and recognize the revenue. And answering the second question simultaneously, there is again this guidance which is available in the standard, which says that the choice of the method, whether it is input method, output method, or whatever method, is a choice which has to be made at inception of the contract itself. And you can't get up after a year or two and say that, no, it should be something else. If it is something else, it means there was an error. And you will trigger Ind AS 8. You will trigger Ind AS 8. So consequently, it is not a free choice of starting with input, then you move to output method. The free choice is not there. So at the inception itself, you need to very clearly decide on, for this fact pattern of performing the obligations, what is the best way to depict an enterprise performance? Is it input, output, or whatever is the method? But that's a one-time choice at the inception of the contract. And coming to the last question regarding how do you depict contract asset? Let me recall the definition, which might help us understand it better. Contract asset is defined as an entity's right to consideration in exchange for goods or services that the entity has transferred to a customer when that right is condition or something other than passage of time. And as far as this expression contract asset is concerned, like in almost all other standards, while the definition uses some terminology, it does not necessarily force you to use exactly same terminology. You could use a terminology which is more contextual in the jurisdiction in which the financial statements are prepared. So in this particular case, if the entity is performing the transfer of goods before the customer is paying it, or even before the payment is due, whatever work has been done, the customer will treat it as a contract asset, excluding any amounts where the right to receive is established, which you would have shown it as a contract receivable, like a typical trade receivable or a debtors receivable. So excluding that. So in this particular case, the committee came to this right conclusion, as always, that in case physical progress of completion as per output method is less than financial performance based on costs incurred, the company should recognize the costs incurred as contract asset or receivables, depending on how it has to be presented, and receivables depending on the legal right which is there. So in conclusion, for the three questions which are there, question number 1, you have to decide on the method of estimation of the work which is being done at the inception. Second is, you don't have a choice of changing the method. Third is, as far as the choice of whether input or output or whatever method, you have to apply it consistently within that contract for the period, and also similar contracts, you have to apply it consistently. So if it is similar, you need to apply the same consistently. And the last question regarding how do you show it as contract asset? In this case, to the extent work is done or costs have been incurred, you can show it as contract asset. If there is any portion which is receivable, for which you have a legal right, you create accounts receivable. Rest of it, you can show it as contract asset, and you are allowed to use alternate terminologies as well. So I'd invite Vivek if he has any thing to add on this opinion, and then over to Dr. Raghavendra.
It was a very well discussed opinion very well discussed opinion. Only one question, sir. Any perspective on where this contract asset should be classified? Although this has not been part of the opinion, but should be classified it as inventories or financial asset or non-financial asset? What is any?
No, to the extent there is a right to recover in the form of cash, that would go as financial asset. That's the receivable part. Rest of it would be as part of inventory, because it's not yet taken the form and form where you are eligible to receive it in the form of cash. So till that extent, it would be an inventory.
So just a related question on this, whether this contract assets would also be subjected to ECL provision, expected credit loss, as the trade receivables are?
No. But I think inherently there's a provision within the standard in terms of if there is an impairment in terms of what you would realize, that would obviously get factored in.
So let's go on to the next one. Sorry, Vivek, you were saying something?
So if the contract is already onerous, I think the provision would already be made. Would be
exactly.
Made, so.
Exactly. Yeah, that would not come as part of 109. It will get addressed in 115 itself.
Yes. So going on to the next one, this is regarding the accounting for major spares. The facts of the case goes as under. The company is engaged in the manufacture and selling of alumina and aluminium generation of power for captive use. Accounting for major spares followed by the company. The company has a policy that spare parts having value of more than 5 lakhs held for use in the production and or supply of goods and services and are expected to be used during more than one period are recognized as PPE. This is in accordance with the Ind AS, and consequent change also have been made in the accounting standards as well now. Spares of critical nature and irregular in use, which can be identified to a particular equipment and having unit value more than 1 lakh are also recognized as PPE. For commencement of depreciation, useful life of major spare is estimated technically, and depreciation on it commences when the PPEs are available for use in the location and condition necessary for it to be capable of operating in the manner intended by the management. The company considers that the major spares are deemed to be available for use when the same are fitted in the machinery, so as to capable of operating in the manner intended by the management. Therefore, the company has adopted the above policy and commences the depreciation from the date of its use in the main machinery. Accounting procedure followed by the company. On procurement of major spare, the same are kept at centrally placed stores and is capitalized as PE without assigning any useful life and depreciation key to begin depreciation. Whenever major spare in use is damaged, a new spare is issued as replacement of the old spare. On issuance of the spare, the useful life is assessed technically and depreciation key is assigned to the newly issued spare for commencement of depreciation. The reason being that the intention is to make the spare available not at the store, but at the location and condition where the same is to be fitted with appropriate technical settings and installation to make it capable of operating. The spares or replaced is de-recognized. This is also very important. So as an auditors, we find this very often that normally the capitalization takes place, but the de-recognition or the decapitalization does not happen. Now, what was the observation of the audit on this? In case of a spare part, as it may be readily available for use, it may be depreciated from the date of purchase. So see what the company is saying, they are saying that they would depreciate it from the date when it is fitted into the machinery. The audit viewpoint is it should be depreciated from the date of its purchase. Now, what are the contrary views of the management on this? The company says that the company operates in a multiple production line where there are similar machines and spares are common between machines used in different lines of production, having different residual useful life. All such major spares are getting replaced within lifespan of 1 to 6 years. The company considers the date of issue as the timing for availability of the spare for use. The company determines the estimated life of major spares considering the date of issue and remaining useful life of the intended machine. Installation and commissioning cost being an important part of such PPE, charging depreciation on cost of spare alone on its procurement, pending capitalization of commissioning installation cost may lead to undervaluation of asset and consequential undercharging of depreciation. Commencement of depreciation on a major spare while it is in the store, not being used in the process of production without any identified cost center would disturb the allocation of depreciation to products leading to non-compliance of measurement principle laid down in Ind AS 2 inventories. Charging depreciation for two spares against a single machine will lead to extra additional depreciation, which is not prudent. Now, the query, the existing practice followed by the company for capitalizing the major spare under PPE on purchase and commencement of depreciation on the date of issue is appropriate and in line with the applicable Ind AS or not. The date of issue of major spares, which the management considers as the date of availability of the spare in the location and condition necessary of capable of operating it for commencement of depreciation is correct. It is appropriate to charge the depreciation on purchase cost only, ignoring installation and commissioning expense, which will be incurred during installation and commissioning after issuance of spares. Charging of depreciation from the date of issue of spares is not more appropriate than the date of purchase, considering the practicality, current valuation of inventory and judgment of the management followed consistently. Useful life of major spares estimated technically considering the life of the intended machinery where it will be used is not more appropriate than assigning a life, ignoring the life of the intended machinery just for commencement of depreciation. So over to Vivek ji for his views on the topic.
Thank you, Dr. Raghavendra. Again, I think this is one standard wherein the more you read the issues emerge, the more issues emerge. I think when you look at the opinions which are finalized by the expert advisory committee, most of the issues under Ind AS or even the erstwhile accounting standards have related to property, plant and equipment. So when you look at this standard is probably one of the oldest standard, and probably when we look at property, plant and equipment as a standard, we feel that it is probably the most simplest standard. But the issues which arise whenever we look at the practical questions which are raised by querists at various points of time, we realize that there's so much of subjectivity which is involved. And so much of interpretation issues that arise when we read the standard is something which adds beauty to the Ind-AS property plan, Ind-AS on property planning. I think one point which I have always been guided by, and MPV sir has always said, when you read the accounting standards, you should stick to the basics. And I think this capitalization of major spares and when it should be capitalized as part of property plant and equipment, when it should be how it should be depreciated. I think a basic principle of prudence and basic principle of sticking to the basics is something which we realize is most relevant when we interpret accounting standards and applying it to the particular types of things. So coming to this particular issue, I think the querist has tried to make a very strong ground on when this major spares which are capitalized as part of property, plant and equipment should start being depreciated. 3 or 4 points which Dr. Goel already pointed out, I think let us just repeat it for the sake of clarity and understanding. 3 or 4 points which the querist made was these major spares, whenever acquired, were not immediately required for the use in the relevant machinery concerned. These were available as standby spares and intended to be used within the respective machinery when they are actually issued to the machinery concerned. So that point which the querist made, along with the fact that installation and commissioning expenses would actually be incurred when the spares would actually be issued to the machinery concerned. They made these 2 points as very strong grounds for classifying these stores and spares as part of property, plant and equipment, but depreciation to commence or capitalization to happen for the purpose of providing for depreciation only when the stores spares is actually issued to the machinery concerned or issued to the specific project concerned for the purpose of actual use of the spares, not when they are available as standby. One more point which the querist made was, since depreciation is a cost for the purpose of calculating the cost of inventories, this cost would not form this cost of depreciation when the spares are available as standby by allocating depreciation on such standby stores to no specific cost center could result in distortion of the value of the inventory also. So these were points which were raised by the querist to justify why these spares should start depreciation only on the issue of the relevant spares to the machinery concerned. Again, coming to these fact patterns, we tend to somehow be swayed or be overwhelmed by the intention test. That of course management is expecting it to use it when the spares are actually used for the machinery concerned. But let us look at how the standard is worded and then try to arrive at the conclusion concerned. We cannot look at one fact, but we cannot just look at the perspective of just the querist. We need to look at analyzing on an independent basis what the standard requires us. So first, let us look at how property, plant and equipment is defined and how the stores and spares which are capitalized as part of property, plant and equipment, how do this come in as part of the property, plant and equipment standard. So when you look at the property, plant and equipment definition, basically what is defined as tangible items held for use in production or supply of goods and services, or rental to others, or for administrative purposes, and expected to be used for more than one period. So it is expected to be used for more than one period. And what is the cost of an item of property, plant and equipment? What it says is cost can only be recognized as an asset if and only if it is probable that future economic benefits associated with the item will flow to the entity and the cost can be reliably measured. So if and only if the condition is satisfied, is only if both the conditions are satisfied. One is reliable measurement of cost, and the second is future economic benefits would be associated with the item is available, and that future economic benefits is available for more than one period. Now, Ind-AS specifies that items such as spare parts, standby equipment, servicing equipment are recognized in accordance with this Ind AS when they meet the definition of PPE. So it says that spare parts, standby equipments, and servicing equipments are recognized in accordance with this Ind AS when they meet the definition of property, plant, and equipment. That is, this is available for use for more than one period and used in the production of supply of goods or services or for administrative purposes, and the cost can be measured reliably. If these conditions are met, the spare parts, standby equipment, and the servicing equipment can be recognized as property, plant, and equipment in accordance with Ind AS on property, plant, and equipment. Otherwise, these items will be classified as inventory. Essentially, if these items are available or future economic benefits are available for over more than one period, and the reliable measurement of cost is possible, these items will be classified as PPE. Otherwise, these items will be classified as inventory. So this principle is very relevant. Basis the facts, the EAC has not gone into the fact whether the accounting policy of classifying above the de minimis threshold, which the querist has applied, of 5 lakh and 1 lakh is proper or not. It has iterated the principles. The principles which are iterated is when the spare parts or servicing equipment can be classified as property, plant, and equipment, which is if it meets the definition of PP as laid down in the Ind AS on PP, which in this case, if it is met, it would be classified as PP. Otherwise, it would be classified as inventories. So once we say that stores and spare parts meet the definition of PP as per the above principles, now we have to look at whether how the depreciation and useful life would be computed. So when we look at the definition of depreciation as per Ind AS on property, plant, and equipment, what it says is systematic allocation of the depreciable amount over its useful life. And what is useful life? The period of expected economic utility of the asset concerned to the company concerned. So period over which the asset would be available for economic use to the entity concerned, or the number of production of similar units expected to be obtained from the asset. This is typically in mining assets or even for certain machinery which have specified production units which can be generated from the asset concerned. So if we look at the first part of useful life definition, which is period over which the asset is expected to be available for economic use by the entity. So expected economic utility life of the particular asset concerned is the period of useful life, and the depreciation is the systemic allocation of the depreciable amount of the asset over its useful life. So we basically allocate the allocation, the cost minus the residual value of which is the depreciable amount over the systemic over the useful life of the asset concerned, and this has to be a systematic allocation. I think when MPV sir pointed out in the last query that we do not have a choice whether it's WDV or SLM, I think this point is very relevant here. It talks about systematic allocation. So when we talk about allocation of the depreciable amount, it is based on how we are economically using the asset is the basis which we decide whether we'll follow SLM method or the WDV method is something which we have to think of. Looking at the economic characteristics of the asset concerned, we cannot just decide based on a principle or accounting choice that we'll follow a WDV method or an SLM method. The choice should be justified based on the economic characteristics of the asset. Now, when is the spare part required to be capitalized, and when is it becoming available for use? Is it becoming available for use when it is actually issued to the machinery concerned or issued to the relevant machinery where the part is replaced, or is it available when the spare part is purchased? So the committee pointed out that the intended use of the spare part is not to be is to act as a standby for the replacement. In case of a non-functioning breakdown or the damage of the primary product, it is ready for its intended use when it is purchased on acquisition and not on the actual replacement. So why have I purchased the spare part? My spare part is purchased to be available on standby. It is not available to be. It is not intended to be used. It is intended to be used on replacement, but it is available for use from today. And the management intends to use it whenever a non-functioning or a contingency arises. So the availability of use is on the date of purchase of the relevant spare part and not on the actual use thereof or the replacement in the concerned plant and machinery. Since the spare is purchased as a standby, even when it is in store after purchase, but before its use, it is in the location and condition and for operating in the manner intended by the management. So the spare was purchased for the purpose of acting as a standby, and therefore the asset was in the location and condition for operating in the manner intended by the management, and therefore it is ready for intended use of replacement whenever it is purchased. And therefore, the depreciation should start from the date on which you purchase the spare part and not from the date when it is actually fitted into the machinery concerned. Now, the committee went on to say that, look, you have capitalized as part of property, plant and equipment when you have purchased the spare part. Now, depreciation should also start when you purchase the spare part because it is available for the intended use by the management on the date you have purchased, which is being available for the standby. Now, how would you calculate the depreciation there? The depreciation which is required to be calculated is a systematic allocation. Now, what can possibly happen is for the period from which you have purchased the spare part till the date of actual release, the allocation could be less because at that time you are not actually using the asset in the machinery concerned, and the wear and tear could therefore be less during the period when it is available for use but not used in the asset concerned. And therefore the depreciation may reflect the pattern of consumption of the relevant spare part or the relevant consumption of economic benefits of the spare part during the period which is available for use. So based on that, you may actually decide on the useful life for the period from where the spare part is purchased till the date it will be used and worn out and used completely. The useful life may be calculated from the entire useful life may be calculated in the manner, and the pattern of consumption of economic benefits be determined for the purpose of allocation of depreciable amount for the period for which it is available for use but not actually fitted or used in the machinery concerned, and for the period when it is actually fitted till the date of ultimate worn out, till the date of decapitalization because of another replacement. So basically, this is how you would do it. It again, the committee went on to say that look, there could be practicalities, or you could apply the maternity practical expediency, wherein the cost and efforts involved in identifying depreciation for each and every spare part may not be possible. So in which case you may decide to calculate or compute depreciation on an overall basis, maybe on a straight line basis, based on the expected pattern or based on the expected utility to the entity of the major spare parts. What is the value of the spare parts as a whole compared to the total property, plant and equipment, intended use, historical data, expected obsolescence, etc. You may decide based on those factors to decide on how the allocation would be done after a spare part is purchased for the first 3 years, for the next 7 years when it is actually used. So basis that, you may actually decide on how the depreciable amount would be calculated for the period the spare part is available for use with the entity concerned. Now coming to with respect to question of the queries concern with respect to how would you account for installation or replacement cost, because that installation or replacement cost would be incurred when the spare part is actually fitted into the machinery concern. It is not being fitted today. So whether you would account for the installation or replacement cost today, whether you will provide for it today and consider it as a part of spare part, or would you account for it in the year of actual fitment of the spare part concern, the committee came to the view that look, this installation and commissioning would be incurred at a later stage when the spare part is actually utilized for replacement, and therefore it has to be, and therefore the installation and commissioning cost should be considered as a separate item to be evaluated whether this would meet the definition of property, plant and equipment, and whether this installation and commissioning expense, if it meets the definition of property, plant and equipment on the date when you incur the installation and commissioning cost, is the date from which you will start depreciating the installation and commissioning cost as an item of property. If these costs are not material, same may be charged to the statement of profit and loss. If these costs are material, the committee looked into and evaluated Ind AS on property, plant and equipment, wherein it said that if an entity recognizes this cost of installation, the cost of replacing part of such item when the cost was incurred. So there's a requirement to de-recognize the earlier part that was replaced. So you have to look at what was the installation and the cost of the spare part that was incurred when the spare part that is being replaced was what was the cost that was incurred. You have to apply the de-recognition principles with respect to the cost that was earlier incurred, along with the installation cost that was earlier incurred, if it was material on that spare part, and apply the de-recognition principle on both the spare part that has been de-recognized, along with the installation cost that was incurred previously when that spare part was earlier fitted. So both the spare part cost and the installation cost, once it is de-recognized, the cost of the spare part which is continuing to be depreciated from the date it was available for use, and the installation commissioning cost which has been incurred now will be added to the carrying item of the property, plant and equipment today to be depreciated over the remaining useful life of the property, plant and equipment to which it is fitted. So of course you need to look at the useful life of the machinery also to decide on the useful life of the spare part to wherein this spare part is or the major spare part is fitted, to decide on the useful life of the spare part over which this cost of the spare part would be depreciated. So again, useful life is a accounting estimate which has to be looked at every year, to be assessed every year based on the fact pattern, based on the economic characteristics of the asset concerned, based on the residual life, so based on which you decide on the depreciation that will be that is required to be systematically allocated over the period of the useful life. Another interesting question which was put forth by the querist in the query was that, look, Ind AS 8, which is accounting estimates, etc., allows the management to use its judgment in developing and applying accounting policies that results in information that is prudent and reflects the economic substance of the transactions. So basically what it said that I can decide to start depreciation of spare parts when the spare part is actually fitted, because that gives me a more fair presentation of financial statements and it is more prudent and reflects the economic substance of the transaction concerned. The committee said no. Look at it, para 10 of Ind AS 8. Look at the Ind AS 8. It says that only in the absence of Ind AS that specifically applies to a transaction, other event or condition, the management can use judgment. So this is a residual clause only to be applied when the Ind AS already present is not able to take care of the transaction or event or conditions which is required to be accounted for. If the existing Ind AS framework, Ind AS 16, is already factoring in how this particular transaction is required to be accounted for, the management is not allowed to apply accounting policies according to its discretion. It is basis the Ind AS principles, the framework which is there. And again, when you look at how the committee has come to the conclusion, it is only sticking to the basics. I think if you look at the basic principle, a spare part which is acquired today, it doesn't make sense for you not to depreciate the major spare when it's available for use. The time factor or the technological obsolescence of an item of major spare parts being there with me and may not be used for the next 10 years could be there. But this does not imply that it would not be depreciated. It has a useful life which is required to be respected, and depreciation over the systematic depreciation over the useful life has to be computed for the purpose of fair presentation in accordance with their. I think this was broadly in respect of the Ind AS on how the 16 on how the measure spare should be accounted for and how the depreciation will be calculated. MPV sir, any comments on this?
That was pretty exhaustive, Vivek. Just one observation, which I would say, as far as depreciation is concerned, while the standard allows till the time you put to use for the spare, and after you can actually follow different one, it would still fit within that systematic allocation. I think from a practice standpoint of view, the timing of when you will put to use, etc., and all is uncertain. I think organizations should apply a lot of judgment and ideally try to have it a blended rate and use that rate consistently over a period of time. That would be more appropriate. Of course, the standard gives freedom, but I would encourage that approach.
So thank you, Vivekji. Now going on to the next one. Next is regarding method to be adopted to determine fair value of investment under Ind AS framework, book value of standalone financial statements or consolidated financial statements. So this is an opinion on an NBFC company which is registered with Reserve Bank of India Act 1934 to carry on the business of non-banking financial institution without accepting public deposit. To promote industrial activity, the company has made an investment in equity shares which are unquoted of G Limited, which is not listed at any recognized stock exchange. The company is holding 0.19% of the total issued and paid up share capital of G Limited. Hence, G Limited is neither the subsidiary nor the associate or joint venture of the company. The investment in equity shares of G Limited is measured at fair value through other comprehensive income. As per Ind AS 109, investment in equity share instruments are always measured at fair value. Equity instruments which are held for trading are required to be classified at fair value through profit and loss account. For all other equity instruments, the equity can make an irrevocable option to classify the same at fair value through other comprehensive income instead of FVTPL. The company has exercised an irrevocable option to classify equity instrument at FTOCI at the time of first time adoption of Ind AS. The company has used the book value method for valuation of investment in shares of G Limited. The auditor pointed out that company has determined the fair value of investment in G Limited on the basis of consolidated financials of G Limited instead of standalone financial statement. So now the question before the board was, which method to be adopted to determine fair value of investment? Book value of standalone financial statements or consolidated financial statements? So over to MP sir for his experts.
Yeah. Thank you, Dr. Raghavendra. Just like to share for benefit of all the members, Portal has confirmed to me that the basis for conclusions for all the IFRS are available in the Institute website, ASB page. It's available, accessible to all of us. And at the cost of repetition, I very humbly request every standard when you apply, please apply it by reading the provisions along with the respective basis for conclusion. Now, coming to the specific opinion, I don't recall when was the last time we had a EAC opinion where the facts were exactly one page. While the slide was one page, but actually the facts of the case was also exactly one page and just 5 points. Normally in EAC, when we read facts, it runs into 7-8 pages of very hard literature. So this is just 1 page of facts. Fairly straightforward case, but I'm sure there was confusion in the application and hence the subject has come to the EAC. As Dr. Raghavendra mentioned, the company has classified these investments in equity shares as fair value through OCI. So the question is, how do we determine the fair value? The company has adopted an approach of taking, because it's a very small shareholding, 0.19% shareholding, unlisted company. The company has taken the book value of the financial statements of the investee entity. And the query was, should I take standalone or consolidated? I think that's the summary. Interest of time, and I would like, there's one more query, and you should get the benefit of listening to Vivek on that query. So I'll just keep this very simple. In this case, investments beyond doubt have to be valued only at fair value. And as far as fair value is concerned, from 109, we go to 113, where 113, the fair value determined is the exit value. And how do we determine fair value? There's a hierarchy which has been prescribed, level 1, 2, 3. Level 1, observable. Level 2, you take inputs and adjust it. Level 3, you adopt techniques. In this particular case, obviously, level 1 is not possible. It's an unlisted entity, so you don't have market information. So level 2, if it is similar information available, you can borrow it and adjust it. But more likely that this fact pattern, it could be only level 3 input, level 3 valuation, which means valuation techniques. There are multiple techniques which are available, cost method, income approach, and all those kind of stuff. So the standard does not tell you which approach to follow. You need to identify what is the most appropriate approach here, particularly from an exit valuation determination point of view, and accordingly arrive at the fair value and use that particular fair value consistently. So while I'm sympathetic with the company's issue in hand, that for a 0.19% shareholding, going through a fair value exercise regularly is not really feasible. But the hard reality is India is required to get it at fair value. And fair value, in this case, being an unlisted entity, it could typically be a level 2 input or a level 3. Most likely, it's going to be a level 3. So you get a registered valuer to value the same and make it available for the valuation itself. So that's in a nutshell about this opinion. So let me hand it over back to Dr. Raghavendra, and probably we can move to the last query.
Sir, just one question here with respect to disclosure on level 2 and level 3 measurements. So level 3 talks about unobservable inputs being used for the purpose of valuation. Level 2 talks about a midway approach. Observable inputs are there. So in case where the company is able to obtain an audited financial statements of the investee company, which is maybe the last audited financial statements which are available, and computes a fair value based on net asset value method, would that imply that I have observable inputs based on the audited financial statements, or would it still be classified as level 3?
Observable is the quoted prices, market traded prices and all. The moment you take a balance sheet, net assets, market adjusted values and all, it automatically becomes a level 3 valuation. Valuation.
So when would it be level 2 and when will
level 2 typically would be like this, Vivek. Like for example, when I value a particular asset, suppose there is an identical asset available for which there is a market price available, quoted price and all active market available. I take that price and I adjust it to arrive at the value for this asset. That would be a level 2 one. But taking the balance sheet of the investee entity and arriving at net asset method, that is not level 2, because that is not observable. It's not there in the market and all. That doesn't qualify as an observable input actually.
Thanks, sir.
Yeah. But that was a good question, Vivek. Actually, I didn't answer it voluntarily, but I think that's a very good question. Good to see the vice chairman is in action here. Good. Over to you, Dr. Raghavendra.
Sir, I think we won't be having sufficient time to take up the sixth one. So,
Okay.
And it's pretty big one, and I remember when this query was discussed in EAC, Vivek ji was very vocal about it. So, but I am sorry, Vivek ji won't be able to take this one.
No, we'll take it up in the next event.
So maybe in the next session we can take it up. So now I would like to hand over the mic back to Piyush sir, our very dynamic vice chairman of Expert Advisory Committee, for his vote of thanks on the today's webinar.
Thank you very much, MPV sir, a very senior member of our institute, past Central Council member, CA Vivek Nevatia ji. Thank you very much, both of you. Raghavendra Goyal ji. A very good evening to all the participants. I'm sure it has been a wonderful session today, and especially listening to MPV sir, where we call him MPV always. So we are used to calling him MPV sir. It has been always very wonderful, especially discussing the expert advisory opinions. I believe that the 5 important opinions could be covered. Of course, he had prepared for the 6 of them. The 6th one, which was in regard to disclosure of promoter investment in another company, could not be covered. But I'm sure we'll take, sometimes we'll bother MPV sir once again, and we'll try to cover up that also. Sir, it would be always a pleasure to listen to you, and members will be benefited largely. To the members, generally, I always say, you may read an opinion which has been done, and a lot of discussions do happen when these opinions are drafted. Each and individual members of the Expert Advisory Committee discusses threadbare of it. But after reading an opinion, you may not realize what is the thought process which has gone while developing this opinion. It is only in such seminars you will actually realize that what is the thought process behind it. So after listening to these seminars and these experts, if you read once again this opinion, I'm sure it will be very helpful to you. It may be this particular facts of a particular case may not be applicable to the case before you have, or the audit issues which you have, but it actually helps you in developing a logic, developing why and how the thought process has to be put in a particular area or a particular index. That's why such webinars are conducted. Our chairman this year has been quite active. Generally, EAC never used to have such type of webinars. But last year onwards, we are doing concurrently. Already for this year, this is a 4th program. 3 webinars and 1 physical program was organized in Mumbai. So we'll try to continue such programs. My request to you is please keep tab of such activities. I'm sure it will be benefit largely to you. It's not important whether you are applying India's or accounting standard. What is important is the logic behind it, listening to these experts who actually analyzes the facts, how the facts have to be analyzed, how it has to be applied, how it has to be interpreted, which is very important. So thank you very much for joining. My special thanks to again MP Vijay Kumar sir, Vivek Nevatia ji, and Raghavendra Goyal ji for supporting this initiative of Expert Advisory Committee. Thank you very much and good evening to all of you.
Thank you all. Bye.